Major funding for these broadcasts is made possible by grants from Capital One Bank, New York Community Bank, Eastern Consolidated, M&T Bank, Sterling National Bank, Meridian Capital Group, Customers Bank, Ariel Property Advisors, Dime Community Bank. Additional funding is made possible by grants from AM Trust Title, AVR Realty Company, Avison Young, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Chase Commercial Term Lending, Chase Commercial Mortgage, Citizens Bank, CPEX Real Estate Services, Colliers International NYC, Cohen Equities, Collins Building Services, Douglaston Development, Levine Builders, Flushing Bank, Friedman LLP, Handler Real Estate Organization, Handro Properties, Hodges Ward Elliott Inc., Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Bank, New Banks, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Group, SJP Properties, Stonehenge Partners, TD Bank, Terra CRG, the Meringoff Family Foundation, the Moynihan Organization, Moynihan Capital Partners, and these friends.
I think it was Willie Sutton said, why do you go to the banks? Because that's where they have the money. That's where I rob the money. Today, I've assembled this group of 4 bankers to provide their insight on what they really see about happening in the banking world due to regulations, due to size constraints, due to different types of environments, and their perspectives on the market. My guests, they include David Bagatelle, who is the Executive Vice President and President of the New York City Metro Market for Sterling National Bank. Kevin Cummings, who is the President and CEO of Investors Bank. Bob Macklin, who is the President of the New York Metro Market CNI for Bank Leumi USA. And last, Eugene Kennedy, who is a Managing Director at CB Bank, Customers Bank. Even though you and I are the oldest over here, banking wasn't always your career, okay? You were in the accounting field, and so is David over there. How has banking changed over the last couple of years with the regulators and the effect of the regulators on what you do today?
Well, I'll tell you, it really changed when the regulators released that December 2015 FIFIC release on commercial real estate. And you know, their focus on specifically the multifamily space has really changed their focus, you know, on CRE concentrations, growth of CRE stuff. And I think it was a study that they did on bank failures, you know, through the 2008 crisis, you know, down especially in the Southeast and Southwest. So I think, you know, in some respects, they don't understand some of the multifamily attributes that we have in the boroughs and things like that.
But when we talk about multifamily, and I'm going to talk about CNI blending it to the commerce and industry market and the real estate, New York City and the region is a different multifamily than the multifamily around the country.
Exactly.
It's a totally different environment, okay? Because we have a rent-regulated environment over here. We have a certain limitation on how much could be built due to the market presence over there. So it's a different thing. So you really can't say all items fit into the same blender on that market. So you as a bank, how have you changed your lending policy towards multifamily and towards real estate financing?
Well, it's really the best part is to be diversified. and have a good mix of lending, a good mix of customers. And that's why you're seeing a lot of people, you know, multifamily has been tremendous to us. We started in that business in 2009, and we have a $7 billion portfolio today with no charge-offs, net recoveries over the last 16 quarters. So that's a beautiful asset class, but you can't live on it. So you have to diversify, and that's why we've been pushing into the middle market C&I business.
Now, if you look at that on the situation, your three other gentlemen on the panel have been more involved with the C&I in aspects than in the real estate aspect. Okay, Bob, of the bank's portfolio in New York, what percentage is real estate?
Overall, the bank's portfolio is about 30 to 35% in real estate. It's a level that we would like to manage down through the growth of C&I. Again, as Kevin was alluding to, it's good to be diversified, and we think C&I growth will help offset, you know, managing that concentration.
You know, one of the areas, David, I go back many years, people look in different markets of C&I. At one time, this region was a heavy market on the apparel and textile business, okay? And at one time, this region also was very big in the jewelry business and so on. But that's changed, okay? Different banks look at it a different way. You came out of Chase, which had a different perspective. They had a middle market team that was knowledgeable in the apparel, but that was a small section under the Frank Lorenzo days. How do you today, with the bank, which is like 10 years old, what do they want to do? What kind of lending?
Well, I think it's similar. I mean, I think we're trying to diversify as much as possible. As sort of a de novo bank a few years ago, you kind of go with what you're good at. In our case, we did a lot of real estate lending. Similarly, we built a multifamily business that's been very successful. You know, I think on the C&I side, you know, there have been a lot of other lenders who've come into our market here in New York trying to do exactly the same thing. So, you know, we were discussing earlier, you know, it's difficult sometimes because you have a lot of banks chasing those similar types of clients.
The leader, who was always in the C&I, goes back to the origins of Sterling National Bank. So Sterling National Bank was originally Sterling Factors, and then when Ron Perlman's family, who was involved with the bank, sold the bank to the factoring company, they went into the C&I business. So the roots of Sterling are C&I, and they continue today, right, Dave?
It's absolutely correct. So about 40% of our balance sheet is in commercial real estate. And we look at, you mentioned diversification, we look at it a little bit differently. We talk more about relationships. So a lot of our commercial real estate clients are in other businesses. They may have a C&I business that they operate. They have their deposits with us. So, you know, pricing is obviously always going to be a challenge in the multifamily space, particularly here in New York. And the way that we sort of rationalize and get to profitability is by having more of the relationship. But, you know, we've always been C&I focused. We continue to be C&I focused. We have a national business that focuses on factoring and asset-based lending and a number of other asset classes, and then we focus on C&I also here in the tri-state area, along with our real estate business.
Now, relating to David's comment, Kevin, I mean, you went into the C&I business about 4 years ago, I think. You were only, I mean, if you look at the origins, you were residential real estate, and then you went into the multifamily.
Going years back, it was just securities.
Securities, right. So you really weren't in that. How is it to grow a department from nothing to 120 people in the portfolio? How difficult is it?
Well, you got to have a lot of patience. The tickets, the loan, the average loan isn't as big as a CRE loan. And like Dave just said, it's building relationships, one customer at a time, and building on your successes and creating a brand in the marketplace and gathering the whole relationship.
So now, since I have 4 different people here, how do you differentiate yourself from someone else? Okay, somebody's saying, okay, and I think David put it in a simple manner. It's relationship, and that's what Eugene also said. You know, it's this relationship. When somebody is unhappy or they're looking that they have a higher need, that they have to increase the amount of lending over there, how do you compete?
5 years ago, 6 years ago, it was taking things away from the big national banks. because there was a lot of turmoil in the market. Now they're doing a better job, and it's much more competitive.
It is for sure. It just boils down to people. I think you have to have the right people. You know, I think the clients expect the technology, they expect the right products, but the real differentiator for you as an institution is having the right people that could be viewed as a trusted advisor to these clients and connect with them and understand their needs and be a partner.
Relating to, yes, Dave.
I was just going to add, you know, for us, I think it's really two things. One is culture. It's the culture of the organization. All of our cultures are a little bit different. That's going to resonate with certain clients. I think the other part of it is your business model. So we do business according to single point of contact model, which seems to resonate with our clients. Other clients, maybe they're not going to like that particular model. So it's all going to come down to kind of finding the best match for the clients.
You know, but you bring up an interesting situation. You're a single point of contact. So are you a single point of contact, similar because of the modeling. You're not really that single point of view, right, Kevin? I mean, when they deal with the real estate team, they deal with one side. When they deal with the C&I team, they deal with a different person.
Yeah, but our C&I guys do CRE too, and they'll classify it. A lot of it's owner occupied. We have a relationship model, and I think we try to stick to it, and we don't, you know, hopefully those walls, I mean, again, as we get larger, fighting those silos is one of the battles that we fight every day, and keep that culture alive of, you know, the customer comes first, and that interest is the most important thing.
Bob?
Yeah, I think our value proposition to our clients is that we're a boutique commercial bank. You know, we don't have investment banking, and we divested retail several years ago, so the commercial space is where we focus. And you know, they get a high touch.
You see, in reality, I mean, if you look at it this, the person who has the most brick and mortar over here, excluding the Astoria acquisition right now, was Kevin, because you did with the New Jersey and your expansion over there was a brick and mortar. But the world today, with remote deposit and everything else, you really don't need bricks and mortar. You know, people were saying, I was talking recently about a number of the Citibank and Chase branches in Manhattan which have closed, and they've become a Blue Mercury, or one has become a Maclo Gallery and other things, because you don't even have any branches.
No, I mean, we have one in the metro New York area. So when that issue comes up, or that objection from a prospective client comes up, you know, the answer is something along the lines of, you know, you don't need a branch. You know, we have our team, we're going to bring you the technology, and, you know, 99% of what you may need to do is solved by some other means of delivery.
Similar theme here. You know, most of their needs, the clients' needs, are solved through remote deposit, as you mentioned, electronic banking. You know, you might get into a situation where you have cash, and that could trip you up a little bit, but, you know, typically we accommodate, you know, that through either armored car or having them keep another account at a local branch somewhere and sweep out.
If somebody asked me 10 years ago about crowdfunding, EB-5 financing, financing of co-working, co-living space, tech companies, it was a different world. It was something that you didn't learn. How do you banks as a bank gain insight and go after this market? Because I know you've been into the financing for the EB-5 credits. I'm not sure if you've done any of it, but it's a different business. How do you adapt to get into a new area? Because, you know, years ago it was IBM. The apparel companies were king in New York City. Today they don't even know about apparel. Okay, it's like the dinosaur.
So I mean, the way we've approached that is we do it one of two ways. Either we figure out a way to educate ourselves and have people internally address those needs, or we go out and we do a lift out of people who have the expertise. Frankly, both have worked for us, and it really depends on what the opportunity is. So as we've done both paths.
You know, tech is different. Tech financing is totally different than bricks and mortar or inventory financing. How do you make a decision that you want to make a loan to let's say a 27-year-old, okay, techie who's gone into this business? I mean, or do you say, let it go to the SBA, or let it go to the private equity, or let it go somewhere else? I mean, because the world is changing each and every day, and you're living in it, and you're representing your shareholders, okay? that you have to be prudent. How do you do that?
Well, a lot of it's risk appetite and what you and the terms and sponsorship. And I think some of these tech startups, we're not in that space, you know, because of the risks involved in that type of lending. Now, if you have a more mature company that's been in business a few years, we're right there with them, and we'll assess the risk accordingly.
Okay, well, what about the diversification today of healthcare? I mean, healthcare has become a major business. I did a show recently on Yonkers and Westchester, and they said the largest tenants moving into Westchester are Montefiore Medical Center, Memorial Sloan Kettering. So healthcare has become a very big market. How are you going after the healthcare marketplace? I know you're relatively large in that area.
Yeah, we focus on skilled nursing and assisted living. It's probably about 20% of our portfolio. We're active in it not only locally but nationally, so we know the space. And clearly, you know, the population is aging, so we still see great opportunity.
You picking on Kevin and me?
Nothing to do with you guys personally.
He's looking at me too.
What
The
about
older
you?
I get, the better I was.
What about you in healthcare?
We have a dedicated team. We had a team
I think you
join
were
us.
heavily involved with skilled nursing and nursing homes.
Yep, and surgery centers, and it's a very, very profitable business. And again, though, you need the expertise and know what you're doing.
So here's a question, and I think Eugene, you're the youngest, so okay, we're going to say, but you're not that far away from Bob over here. Okay, how do you go out there today? You know, people they graduate college, they want to be an investment banker, or they want to go into the tech space, or they want over there. How do you go out there and recruit new people for the bank, especially since we discussed prior to the show that there aren't that many training programs anymore, okay? Or, you know, how do you go out there and solicit and get that team, okay? How do you incentivize that individual to be there, okay? You know, sometimes you have stocks, sometimes you have bonus formulas. How do you do it? Dave?
So we've actually brought back the training program. So we actually now are credit training individuals like the old days. And we have an intern program. So we bring in interns during the summer from local schools as well as from some of the Ivies and some of the liberal arts schools in New England. And they come into it and what you try to do is demonstrate to them that banking isn't, it's a little bit different than what maybe they thought. You try to engage them during the summer and make it interesting for them and get them interested in it. And that's part of it, because I think a lot of it is they have a preconceived notion of what banking's about. It's not always a positive image, and we try to change that image for them.
Kev?
We created a CMA program at the end of 2015, probably through, our graduation was this past summer, first group, 15 students, and of the 15 offers that we had, mainly local schools, a couple schools in New England, we got 15 out of 16 of our first choice that accepted the offer. They come in, it's classroom, on-the-job training, and they bring, actually it was fun to work with them. You know, they bring good energy into the room, they're excited about joining it, and it's been a successful program.
You know, I think for us, you know, we don't have some of the formalized programs these guys were talking about, but I think because there's been so much movement of banks in and out of the New York market and certain businesses, and I mean, we've all spent time at you know, a bunch of different institutions. You know, we have friends and colleagues at all these different institutions now. I think a lot of the best hires we've had has been through that personal and professional network, in locating folks who are in an institution where maybe they're not using their full skill set.
How do you retain, my bigger question is, how do you retain talent? David and I remember from a bank that we were once both involved with, went into business 17 years ago, they may have had people who were in their 50s, or now they're 70, okay? How do you retain the talent to do transition to the next generation? If you have a 70-year-old banker who wants to maybe retire, and you may have not brought in the next generation, how do you keep the business over there? Dave?
So I think it goes way beyond compensation. I mean, the easy answer is you just pay people, but I think you have to make it interesting and you have to engage them and make them feel like a part of something, make a part of the team. So yeah, I mean the money is important, but it's not the only thing. I think I mentor a lot of athletes from my alma mater, and what's important to them is they want to do interesting stuff, meaningful stuff, and get paid fairly, not make millions of dollars a year.
Kev?
You know, it's funny. The 80s was the greed decade. Everyone cared about making money. The 90s was the leisure. I needed time off, time to myself, time for my family. And I think now people want to feel a sense of purpose and have a passion for what they do. So I think now it's a combination of your culture. Am I part of something that's greater than me? And am I part of something that's a team that's doing something
But if
better?
if you look at the senior management of your firm, okay, both you and Dom come out of different worlds. You know, you're not out of the traditional banking world. You come out of being a CPA and a partner of a Big Four accounting firm. Dom comes out of the regulation side. David came out of, accounting originally, but he's been a banker for basically his career. Bob, you've been a banker your entire career, and you've been a banker also. How do you get that creative person who could be a dynamic salesperson or, an interesting personality to get? I mean, I think in a way it relates from the senior at the top. I hate to say, years ago, Leumi was known as they would bring in some Israeli who was a bureaucrat and was difficult. Now you have Avner, who has a different personality. You know, when Dave was at Republic, it followed the mantra of Safra. Okay, that was the mantra. Before you joined the bank, it was the securities. They took deposits and they invested in securities. How do you find that next Jamie Dimon, okay, or the next Kevin Cummings, or the next Dave Bagatelle? I think it's very difficult.
Well, it's leadership and mentorship.
Yeah.
And I think we all mentioned it, how important mentorship is, to get to that next level of leadership. I mean, John Maxwell wrote a book, 5 Levels of Leadership. Positional, you have a position, it's like the Army. Second level, they like you. Third, you're competent. Fourth is you make leaders, you mentor people.
Sure.
And the fifth one is you become a guru like Jack Welch. That's the level that we're all striving to get to, where you create people that are in the pipeline to make sure the company, continues to grow.
So here's my next question. There's always questions going on, new Fed chairman, different personalities, okay, North Korea and all the other situation. How do you take all these effects taking place on your lending?
I think it's on the lending side. It's I think we see it with our clients today, depending on what industry they're in. A lot of them are concerned and just don't have a lot of visibility. Never mind a year or two out, but they're having trouble making decisions about should I buy this piece of equipment? Should I start this new division I've been thinking about?
I mean, we have a potential tax reform act that people don't know. I did a show on Yonkers that people were saying, we're worried about, we don't know if people lose the deduction for the taxes, there's going to be an effect on the homeowner and on the consumer.
Yeah. I think your clients want to see you're consistent. I think, like you said, there are pending political things right now, that tax reform and others that may affect the economy. But I think your clients want to understand from a credit perspective, especially, that you're consistent. Again, we're lending to people, we're lending to the right sponsors. So they should come out on the other side, and we should be there with them.
It's a hard business. I mean, it's complex. There's all kinds of economic factors which are obvious, but geopolitical factors. You have to deal with people. You're dealing with in a regulated industry, so it's not
I think one of the biggest difficulties that you bring up, definitely you said, is the regulated industry. Okay, this industry has been regulated really hard. The size, like we were talking before, you want to stay under 10 billion because you're under this group of regulators. You're under 50 billion, you're at this group of regulators. It changes over there. The effect of regulation on your bottom line, the cost of the administration over there is significant.
We own a franchise from the government.
That's right.
Right? They're a partner. Sometimes they're a 55% partner, sometimes they're a 40% partner.
But so as the question, since all of you are public, but you're public in Israel, so it's a different case. If the taxes are reduced, do you see the banking perspective increasing in the stock value and also in the amount of business that you do? Because corporations are going to have lower taxes.
Tax reform and a lower corporate tax rate will increase economic activity.
I'd agree with that.
Yeah, for sure.
Absolutely.
So if you had my crystal apple over there, how do you see 2018 for a time of being as a banker?
I think more of the same what you're seeing right now, unless things kind of shake out from a political standpoint, because there is a lot of uncertainty right now. But I don't see interest rates moving heck of a lot. I don't see inflation moving a whole lot.
Do you see more mergers?
I think so.
Yeah.
I think the M&A activity has to heat up. People might be concerned that we're at a height of the market. Things might, move sideways, and it might bring more people, more sellers.
Do we see more de novo banks? Or I mean, at one time we had the world of de novo banks are not going to be over there.
I don't think so.
No, because the cost of doing business.
Yeah, that horse has left the barn.
It's I mean, having started 2 de novo banks, it's just too expensive to make it happen, especially in the New York metro area. It's just way too expensive to do business here, and the break-even point is too high. And frankly, investors that would invest in de novo banks can find better return investing in other things. So there's no reason for that.
I think the de novo ones will look probably closer to like a fintech type model. They were probably not going to look like some of the other banks that have been around for the last 20, 50 years.
Okay. So in summation, the apples are relatively shiny for 2018. There are challenges ahead, but I think all of the bankers over here are going to be able to live with the challenges and continue to grow. I'd like to thank David, Kevin, Bob, and Eugene, and I'll see you next week.